Hi, Ranjit Singh, London Stone Securities. Okay, couple of interesting statistics for the S&P 500. So in the month of December, the S&P 500 lost 9%. Now, normally in the whole course of a year, 9% would be pretty poor. The fact that it was concentrated in 1 month is pretty devastating. However, as you probably know, in January, the S&P also recovered. It recovered 8%, so almost the entire loss in December was recovered in January, which made it, of course, the best year for the last 30 years. However, another statistic which I found very interesting was this. It's only happened in 3 occasions in the last 20 years where the S&P has made more than 5% in the month of January. On 2 of those occasions, the S&P continued to rally throughout the year and ended up stronger than when it started. But on 1 of those years, it ended up weaker. Now, call me a pessimist, but I suspect that we may be in the latter situation for 2019. And I'll explain why. I believe the problem we have at the moment is that there are several what I call best case scenarios being priced in with the market. So, for example, there's an assumption that the US and China will somehow miraculously fix the trade war. I don't think that's going to happen. As we speak right now, we've got a US delegation sitting in Beijing trying to work out a way in which they can solve this problem. The problem is that Donald Trump believes that global trade is a zero-sum game. That's not the case. Global trade helps to increase profitability of corporate earnings globally simultaneously, and the US doesn't have to win in order for China to lose, and China doesn't need to win in order for the US to lose. So it's not a zero-sum game, and there lies a problem. So I don't think that's a good thing. The problem is the stock market has priced in that will be resolved, and if it doesn't get resolved, we're going to see equity prices fall. The other best case scenario also is about the Fed. Now, last year, the Fed raised interest rates 4 times, and the FOMC, the Federal Open Market Committee, last month joined forces, and they looked at keeping rates on hold between 2.25% and 2.5%. So again, there's an assumption now that the Fed won't raise rates. Now, I'm concerned that the Fed will raise rates, and if the equity markets continue to pick up, which is what we've seen, there's more likelihood that the Fed will raise rates. That is going to cause a breakdown in really the US economy, because of course everything is built on low interest rates. It's going to increase the borrowing, reduce investment, reduce spending, and of course it will also increase the dollar. So that's a real concern for me. And also I'm concerned about corporate earnings. Now, corporate earnings in the US are still relatively strong. However, you've got to look at statistics. So for example, if you look at mainly US-led companies which do most of their sales abroad, their earnings are only around 8%. However, if you look at US companies which are mainly domestic based, and most of their sales, more than 50% of their sales are within the US, their earnings are 16%, almost twice as much. So there's a shrinking now of US exports, and I think that's possibly going to be because of the fact that the US export market is starting to slow down, the fact that US dollar is strengthening, and I think that's going to cause a great problem going forward. However, another statistic which I did see is the PE ratio. So, for example, the PE on the S&P 500 at the moment is 15.8. The 10-year average is 14.6. Therefore, the PE ratio now, relatively speaking, on the 10-year scale is actually quite high. Now, it is still less than the 5-year average, but it is catching up quite quickly. I'm not suggesting you can't make money. That's not the purpose of this short video. What I'm saying is it's very dangerous, and the return to risk ratio now isn't in your favor. So if you still want to make money in equities, there's a lot of money to be made, but it's a trader's market, it's a volatile market. I don't think sitting on your investments just waiting for the market to go up and expect it to go up by 9 or 10% per month for the rest of the year is realistic. That's not going to happen. And of course, it's also very much a shortest market. So a lot of good things have to happen in order for the markets to stay where they are. At the moment, Dow's at 26,000. You've got the S&P at 2,700. So the markets are expecting to start to increase around those kind of levels. But be very wary, and I wouldn't be surprised if we're going to see a correction and then some settling down. Hope you enjoyed it. Hope you got some value. See you next time.